Hey guys, Toby Mathis here, and today we're going to talk about 5 tips for investing when inflation is high. Like, you can't avoid the fact that there are a lot of people chasing around fewer goods right now. We have supply chain issues. We had this massive dump of cash during the pandemic, and people's savings accounts have never been higher. So you have people that are flush with cash and fewer items to purchase, which is doing what to those items? That's the definition of inflation. It's driving them up 7.5% if you listen to the government. But we all know for stuff that we're actually buying, it's much, much higher. In fact, in many metropolitan areas, just rents alone are in the 15% range, 20% range. Prices of houses, last year nationally went up 20%. It's crazy. So here's the 5 areas that you go into. Number one, I just mentioned real estate. I just mentioned how the rents have been going up and prices have been going up. If you can get your hands on cash flow positive real estate, meaning that it's an asset, I buy it, I rent it, and even after the insurance, paying a property manager if I have to get one, covering repairs, covering any costs associated, including insurance, real estate taxes, all of that, then I'm still profitable. If I had to borrow money, you even factor that in. And if it's net cash flow positive, that is a great investment because inflation really pushes up equity markets, really pushes up real estate. Always has, always will. Number two, since we mentioned equities, is invest in recession proof companies. What type of companies am I talking about? You can look at your Walmarts, your Lowe's, your Targets, your Apple, your Adobe, O'Reilly Auto Parts, Coca-Cola. Love Coca-Cola. It's one of Buffett's favorites. Apple's one of Buffett's favorites. Like, there's a bunch in there. Johnson and Johnson, Kroger. People are still going to eat no matter what. Like, they may not go out to dinner and a movie, but they're definitely going to the grocery store. AT&T, we're addicted to our phones. They're not going anywhere, plus all that entertainment, all that good stuff. Even though AT&T has taken a few shots recently because they lowered their dividend, still a tremendous yield, over 4% yield. They're not going anywhere. Royal Dutch Shell, if you like energy, NextEra Energy, Dollar Tree, even things like Altria and Molson Coors, the kind of your sin companies, they always seem to do all right. If inflation is high, people are still doing those things. As far as entertaining themselves, they're not going to deprive themselves of a decent beer, right? Other thing you can do is diversify your tax portfolio. Now, the way that I diversify my portfolio is different than most. I still do this 30-30-30-10. And what I mean is that diversification for a lot of people is they think, oh, I need to own an ETF and I'm going to have a whole bunch of companies or I'm going to buy a bunch of mutual funds. The problem there is that you're still exposing yourselves to equities, and you may have 2 mutual funds and they're each 20% in the same company or companies, and you didn't diversify well at all. So I use a different calculation. I do 3 main areas. I do income producing, dividend paying stocks. So equities that produce a dividend, that pay out a profit, those that have been historically good payers of dividends that increase their dividends every year, those are what I look at. So, for example, Coca-Cola, more than 55 years of increasing its dividend every single year, no matter whether we're in war, no matter what's going on, these companies continue to pay out dividends. There's a ton of them that you can choose from. When I say a ton, like Dividend Kings, there's about 30. When you have aristocrats, now you're up to about 60. And when you look at what we kind of call our challengers, or companies that are 10-year of increased dividend payout, you get around 100. It's a ton of them, but it's still a small universe. So it's very easy for individual investors like me to go out there and kind of pick it out. And then I'm diversifying myself by going into those. The other area where there's 30% is real estate or real estate equivalents. And when I'm looking at real estate, yes, I love single families. Yes, I love multifamily. I love commercial. I love self-storage. I like buying individual properties, but maybe that's not me. Maybe I'd like to do a REIT instead. A real estate investment trust is a security that represents real estate that's held in a holding company called a real estate investment trust that's paying out 90% every year of its income. That is a nice investment for me to get into, where I'm exposed to real estate if I don't want to manage my own real estate. Now, I'm an avid real estate investor. I'm always going to do that, but I'm not saying you have to. Another area you could get into if you want to get exposed to real estate and you're a high net worth individual that you qualify as an accredited investor is you may invest in private placements where people are going in and buying buildings together or buying groups of real estate. I've seen everything to build to rent, to self storage, to multifamily, shared housing. I've seen it all this year, and we're going to see more of it because it's such a huge issue. Statistically, we are underbuilt in real estate to the tune of about 3 to 3.5 million units for the moderately housed. So lower to moderate income housing, we are completely devoid, which means there's a huge niche for shared housing that's going to be a big deal. You're going to see private placements going into that, these little funds where they go in and they buy up land and put on rentals, or they're buying up buildings and doing remodel to put in shared housing. You're going to see more of that going on. So that's another one. Here's the next area. Oh, by the way, for diversification, the last section, that last 30% is managed portfolio. You're either doing a mirrored portfolio, like in our company, Infinity Investing. You can go in and mirror. I think there's 5 different portfolios in there, and you're just basically doing a group of different companies that you're mirroring somebody else. So it's not just you who's making that decision. You start to lean on somebody else. Or you go to a registered investment advisor. We have those too, where somebody's charging you maybe 1% to manage a portfolio. The whole idea is that you're stepping back from control and allowing somebody else to start making those calls, but without paying these exorbitant fees like that are in mutual funds and things like that, where it's 5 times as high. What I'd prefer is that you do something where if you're mirroring a portfolio, it literally costs you nothing. You're just saying, hey, here's the portfolio. I'm just going to mirror this set portfolio and go about my business. The last 10%, so I go 30, 30, 30, 10. 10 is really cash or cash equivalents. That's your gold and silver and crypto, which we'll get to here in a second. That's where you're putting a small amount of your portfolio that's an easily to liquidate fund that's available to you. And so it's going to be US dollars. It might be silver. It might be some gold. It might be some Bitcoin, but it's not going to be more than 10% of your total portfolio. All right, next area we're going to get into is to buy treasury inflation protected security. They're called TIPS. And what it is the principal is adjusted for inflation. So you may be using something like a Bloomberg methodology, you may be using some version of the CPI, but it's indexed for inflation on the principal of the bond that you're buying. So let's say that it's a 1% yield and you're like, oh, that's really great, but it's indexed for inflation. So if inflation goes up, and let's say it goes up 4%, well, your principal goes up 4%, and the 1% coupon rate is based on the principal. So let's say I put $1,000 into something, it's indexed for inflation, it goes up 5%. So now I have $1,050 and I get 1% of that. So I'm going to get the $10.50 on top of it. So overall, I did okay. Hey, it's better than sitting it in a savings plan, which is next to nothing right now, right? There's just nothing there. The interest rates are so low. You're not making anything. This way, at least I'm hedging myself against inflation. It's called TIPS, and there's a lot of money that's been dumping into it because people are scared of this inflation. So they're running into that. How about precious metals, gold and precious metals? So maybe I'm going to go into that realm. Now, I'll just tell you, not the biggest fan. I tend to like assets that pay me. So precious metals like gold and silver, I'm putting in that 10% sliver. The vast majority of my portfolio, 90%, is in income producing types of assets. But you can go in there to hedge against inflation. Speaking of hedge against inflation, a lot of people think cryptocurrency is a great place to go if the US dollar is getting beat up and inflation is causing problems. The only issue I have is that it seems to mirror the kind of the inflationary numbers. Crypto, especially Bitcoins, reacted negatively when inflation's numbers have come out, and it's like, whoa, it seems to be tying there. Even though instinctually you say it's a hedge against inflation, I'm not saying don't buy crypto. I'm just saying buy crypto, knowing that it hasn't been doing exactly what it's advertised to do, and that is that it seems to be affected when the inflation numbers come out. I'm not going to say don't buy it. I'm going to say keep it in that 10% realm. I own Bitcoin, I own Ethereum. I don't see why everybody would not be exposed to some of that. Last area is the option trading. It's one of the best things I can do if I have a portfolio that's kind of stale. So I have a bunch of securities and I'm worried about inflation and they're not going to jump up. By the way, avoid growth stocks like the plague during an inflationary cycle. One of the things we're going to see to combat inflation is they're going to raise interest rates, and that makes it much more expensive to be a growth company because they're basically looking for debt and they're looking for shareholders, right? The shareholders are buying their company to raise money. So they're either doing it through debt or shareholders. When shareholders no longer like it, guess what they're going? They're going to go out there and get debt, and debt's becoming more expensive. So avoid those. But if you do have companies that are good, like you have good inflation protected companies in recession proof stocks, things like that, where you're not too worried about the overall economy. These are good companies. Again, your Walmart, your Lowe's, your Targets, your Coca-Colas, your AT&Ts, all these. One of the things that you can do is sell options on them. I'm not going to say buy options because I think that's gambling. You sell options when you own the security. So I could even sell an option if I like a security, like, hey, I want to buy Walmart. I could sell a put, take that money in, and then if somebody puts me the stock and makes me buy it at my put price, I was going to buy the company anyway, so I just got it for a little bit cheaper because I got that little bit of premium there. So even if I'm like, hey, I'd like to buy Walmart at whatever the price it is, I can sell a put for that. I get that extra money. Plus, if I end up getting the stock put to me, now I have it and I can sell an option on it and generate some more revenue that way. How much can you generate? Between 6 and 12% a year, really, on the sale of options. That's what I've seen. That's what we use inside of our Infinity portal, is that we're generally looking at companies where there's enough premium to make it worth buying them. And so now you have 5 good ideas to combat this in high inflationary cycle. And then you're not going to be looking at it going, oh, woe is me, and jumping out of the market. Do not do that, please. Every time there's a recession, people go out there and dump. Every time inflation's going high, people start to freak out and they dump. Do not be that person, because history has showed us one thing, which is it's all about the long term, baby, and nobody can time this. You just keep holding on to good companies and you wait. You take this right hand and stick it underneath that right butt cheek. Take your left hand, put it underneath that left butt cheek, and sit on your hands and wait, because you get rewarded when you buy really good companies and you're patient and you're willing to go through these cycles. In the meantime, you have some other things you can diversify into, or even ways to generate additional income off of those companies while you wait for whatever's going to happen with this inflationary cycle, while you wait for the Fed to start jacking interest rates over and over and over again over the next year. That's what you do, is you say, hey, you know what? I'm going to make money on it in the meantime, and I'm going to protect myself. Here's some things I can get into. So I just gave you 5. There's obviously more, but if you get into those 5 areas, you're not going to be disappointed, and you're just going to go through this like hot knife through butter. You're going to be just happy as a clam, going, geez, I am so glad that I restructured myself or looked at it differently. And by the way, every time that there is a downturn, look at it as everything's on sale. It's a great buying opportunity to continue to increase your investments. And if you're smart about it and you focus on those 5 areas, you're going to be way ahead of the curve.